Ladies and gentlemen, welcome back to another video. I'm your host, the Dividend Aristocrat, and today we're going to be talking about 3 stocks that I'm looking to buy more of in 2025 and 3 that I'm planning on selling. Now, if you do enjoy this type of content, consider subscribing to the channel. I'm on my way to 2K and I would really appreciate it. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. As always, let's start by taking a look at my portfolio dashboard. In total, I've invested $33,444 into this portfolio, and my current value sits at $48,687 with an unrealized gain of $15,242 and 45.58%. Now, forgive me if I am going through this a little bit fast right now, but we do have a lot to get through in this video, and if you guys want to see my full portfolio breakdown, I'll pin up a video right here where you can check that out. Now, in terms of dividend income, I do earn dividends in this portfolio, and so I've earned $1,312 so far, and each year I'm expected to be earning $777 per year going forward. Now, that yearly projected income puts my portfolio yield at 1.6% or my yield on cost at 2.32%. Now, without wasting any more time, the 3 stocks that I want to be buying in 2025 are CVS, Walgreens, and Paramount Global. Now, before you guys all click off this video, I'm definitely joking about that. I am not considering buying those and I'm staying pretty far away from them this upcoming year. So for the first company I'm considering buying, we have Apple, ticker symbol AAPL, and right here you can see my own personal holding in this position. Now, before we look at their performance and financial metrics, let's first look at my position as a whole. So my average price paid is $136.89, and the current price sits significantly above that at $237.33. That's because I was buying this company in when it was dipping down pretty heavily in, I believe, 2022, and since then it has just shot right up. In total, I have purchased 9 shares, and with my dividend income being reinvested each and every quarter, I've earned a whole 0.095 shares of Apple, which is basically nothing, but over time, of course, it will end up compounding. Now, my original position was a $1,232 investment, and my current percent gain is 75.2%, which is very strong and one of my top performers in the portfolio. Now, a big reason why I want to invest more into Apple, even though I already hold this company, is because my allocation is lower than what I would like it to be at 4.4%. When I had originally added this position to my portfolio, it made up between, I believe, 6 to 9% of my portfolio. I can't quite remember how much it made up during that time, but it was a very significant amount. Since then, I haven't invested any more capital into Apple, and because of that, the allocation has gone down as other companies have gone up in share price, and I've added in more positions into my portfolio. With how dominant of a company Apple is, I definitely think it deserves more than a 4.4% allocation in my portfolio if the price is right. Now, what I mean by that is that currently I'm definitely not planning on adding any more money into Apple at these current price levels. It's currently trading at about a 34 to 37 price to earnings ratio depending on the stock price that day, and that's just far too high for this company. I think the growth has definitely slowed down and it has to show much more signs of growth before it's worth that kind of valuation again. Now, looking at the current price, in terms of valuation, I would definitely prefer adding it well below a 28 price to earnings ratio. Somewhere between 24 and 28 would be much more fair in my opinion. Now, if the stock price did dip significantly enough, maybe towards $160 per share, I would definitely consider adding some more into my position, but at these current levels, I'm going to have to hold off. Now, it might never hit those valuations and prices again going forward, but I'm totally fine with that. I'm perfectly happy holding my position as is, and if the opportunity arises, I'll just be adding more into the position. Now, looking at its year-to-date price chart, we can see that it's climbed pretty significantly, up 27.84%, which is very good growth for the company. But then look at this price to earnings ratio right here at a 39.01, which is very, very high. In the past year, the company is up a little less at 25%, but in the past 5 years, it's still up 255%. So this company has performed very, very well over the long run. If we look at it since 1984, we can see how significantly it's up 215,000%. So any early investors in this company would have been rewarded very nicely. Now, hopping into stock intent, we can see some of the reasons for concern that I have with this company. If you guys are interested in giving this software a try, you can use my affiliate link that I'll leave down in the description and in the pinned comment down below in order to get a 7-day free trial with the software. Now, what we can see here right away is their revenue growth is actually not that consistent. We can see that it grew pretty consistently up until 2020, where it had a very big jump into 2021, and since then it has remained pretty stagnant. Now, a lot of other companies in this sector, especially ones with such high valuations as Apple, have much more consistent revenue growth than they do. Now, Apple has historically needed upgrade cycles in order to really bump up their revenue, but we can see right here that a big upgrade cycle happened probably from 2020 to 2021, but since then it has slowed down significantly. Now, regardless, I still have faith in the company. I think it's a very strong quality company, and I mean, if you ever go to an Apple store in any of the malls, you'll see they're basically packed all the time. Now, I myself recently purchased a new iPhone, and I actually had my old one for about 4 or 5 years, so it lasted me quite some time, and it's about time I had to upgrade the phone anyways. Now, even though I have used Androids in the past, using an iPhone now, I can't really go back to Androids. I really like the user interface on iPhone and the experience that I have using those devices. Now, even though I got a slightly older model, it still ended up running me almost $900 with the amount of storage that I needed on the phone, and so this company I think is not going anywhere anytime soon. Now, one more interesting data point is I had some family come from overseas, and the first day they came over, they spent over $2,000 at the Apple store. Now, that's important to me because it shows that they have a very loyal user base who is willing to spend a lot of money on their products. Now, of course, since their market shares in phones is already so large, it does make it a little bit more difficult for them to grow, but I do think that this is a very innovative company, and we'll see how they perform in the next couple of years. Now, another thing I like about the company is their consistent growing dividends. It did grow faster back in 2017 to 2018, and since then it has slowed down to about 4.5% per year, but the company also does a lot in stock repurchases. In 2024, they did authorize a $100 billion stock repurchase program, which I do believe is the largest to date. Now, stock repurchases are very powerful for shareholders because they help increase your ownership in the company and they help increase the per share metrics of the company. Now, the next company I want to be adding more into my portfolio in 2025 is Microsoft, ticker symbol msft. Now, I'll just keep adding the companies into my portfolio holdings section as we go along so you can see where they stand in the portfolio. So Microsoft has performed much better than Apple for me in the past couple years, and we can see here that I paid $231.78 per share, about the same time frame as I was buying Apple shares. Now, since then, the price has surpassed $423 per share, and I purchased 4 shares in total with 4.067 shares after dividend reinvestment. Now, this was a smaller position than Apple originally at $927.11, and it still is to this day, but if I were to go back, I would have bought some more Microsoft shares over Apple because I think the company has a very good runway ahead of it. In terms of total return, it's currently sitting at 85.76%, but a couple months ago I was sitting at over 100% total return on this exact same holding. Now, if you guys do want to check out that video where I talk about 3 of my holdings that eclipse at 100% total return, I'll pin it up here for y'all. Now, the dividend stats are nothing interesting, although Microsoft does have a good dividend growth rate at over 10% per year usually, but we can see here that my allocation is at 3.5%. Again, similar to Apple, this is such a high quality company that if I have the opportunity, I'll definitely make it at least a 6, maybe 7% holding within my portfolio. Now, just to clarify, at the time when I was first purchasing Microsoft shares, just like Apple, it was a much larger percentage of my portfolio relative to my other holdings, but since I've been adding to other positions instead, it's of course come down. Now, one thing I do want to show real quick is how Microsoft makes its revenue. So we can see right here that this is for Q1 of 2023, which is no problem at all. This is still very relevant for what they're doing today. Now, of course, since then, some of their segments have grown faster than others, but this is still pretty relevant to look at. So their productivity and business processes segment makes up about $16.5 billion of their revenue per year, and that includes Microsoft 365 and LinkedIn. Now, below that, we can see their cloud business generating over $20.3 billion per year, and in 2024, it's even larger than that. Now, below that, we can see their personal computing segment, which is about $13.3 billion, which includes Xbox and their Windows operating system. Now, in terms of net profit, in Q1 of 2023, they brought in $17.6 billion worth of net profit, and that's very good. They have very large profit margins. Now, in terms of their stock performance, they're actually not doing as well as some of the other Magnificent 7 stocks. We can see that they peaked in July of 2024 at about $467 per share, and that's when I had a larger than 100% return on my holding. Since then, the company did dip in stock price by quite a bit, about 15% in the first month, and even now it's still down about 10% from its highs. Now, the company was getting very overvalued in July, and I'm pretty sure that it was just a correction in the stock price that sent the price down. Now, even now, the company still trades at a 34.95 price to earnings ratio, as you guys can see down here, and that's still very rich for the stock. Now, they definitely deserve it more than Apple since they have much better recurring revenue and much more consistent growth, but at the same time, this is still very high valuation and too high for me to be investing in. Now, in terms of what price I would consider buying more of this company, with their current financial metrics, I think around 380 is when I start considering buying more into Microsoft, but around 360 realistically is what I'd like to see. Now, anywhere under 350, I would certainly be adding into my position, just depends how much since I have to buy whole share increments each time. In the past year, the company is only up 11.76%, and that's because a lot of its growth came in the past 5 years, and especially the past 2 years here, we can see how quickly it climbed. Now, hopping back into stock intent, this is a very large company as well with $3.22 trillion market capitalization, but right here we can see the revenues, and compared to Apple, look at how much cleaner and how much more consistent their revenue growth is. Now, aside from a dip in 2016, we can see that the revenue has basically shot straight up, and that's because of their subscription services which generate recurring revenue for the company. Now, I think most people around the world have at least used some sort of Microsoft product, whether it's their Windows operating system or their Office 365 products. Now, although there is some competition for some of their products, like Google Sheets and Google Docs, Microsoft is still very dominant in their field and their moat is very large. Now, in terms of dividend history, they have a very consistent dividend track record, just like Apple does, but in the past couple years, they've continued to grow their dividend in double-digit metrics, which I really like to see. Not only that, but of course, they have a very large share buyback program, which I think is about $70 billion for 2024. I personally use Microsoft products every single day, so I definitely don't see this company going anywhere anytime soon unless the Department of Justice ends up breaking them apart. Otherwise, I do believe that this is a very strong company. At the right price, I will be adding more into my position. And for the last company that I'm looking to add more into in 2025, it's S&P Global, ticker symbol SPGI. Now, although this company lags behind Apple and Microsoft in terms of total return, at least in my personal portfolio, it is actually the company I most want to add into next year if I have the opportunity to do so. Now, my average price paid for it is $365.77, and I definitely overpaid for some of the shares I purchased, but it's very hard when I can only buy whole share increments because of Vanguard's brokerage system. Now, the current price sits at $522.51, and in total I purchased 5 shares. With dividends reinvested, I have 5.051 because the dividend for S&P Global is also very small. Now, my total amount invested was $1,828, and that's kind of what I was referencing before. As time went on, I began adding larger amounts of money into my newer positions. My current value is at $2,639, and my total return is at 44.31%, which is still very strong. In terms of allocation, it currently makes up about 5.4% of my portfolio, but before that, it was of course a larger position, but it's since gone down. Now, in terms of performance, the company has performed very well year to date, up almost 20%. In the past year, it's up 25.65%, which is very strong. Now, in the past 5 years, we can really see where the opportunities opened up for purchasing this company. In 2021, it was significantly overvalued, and because of that, it dipped a lot in share price, down over 40% at some point. Now, unfortunately, I don't think I purchased these shares in October of 2022, but I still purchased them at a decent discount, and since then, the stock price has shot right up, all the way up to $522.51 that it's at today. Now, one concern that I have with S&P Global is that their price to earnings ratio is at 46.1, which is very high for any company, but their forward-looking price to earnings ratio is still much more reasonable since they're expecting some pretty strong growth going forward. Now, in terms of what price I consider buying more into the company, really, as much as I want to add more into the position, it's already a very large position of mine, and I think it would have to drop down to about $400 per share for me to consider adding more into the company once again. Now, there is one more case where I'd consider buying more S&P Global stock, and that's if there's a very strong overreaction in the market, which we have seen with S&P Global before. For example, in the past, they have announced very good earnings, but still dropped a lot in stock price. So if that does happen and drops enough in stock price with still good financial fundamentals, then I would probably purchase more of the company. Now, since it's only in whole share increments, I would only buy maybe 1 or 2 more shares because they're about $500 per share. Now, for S&P Global, I thought it'd be fun to take a look at their latest investor presentation, which you guys can all find in the investor relations page on their website. So taking a look right here, we can see their big highlight is that the revenue increased 16% year over year, with revenue from subscription products growing 8%, which is both very good for the company. Now, their adjusted earnings per share grew 21% year over year, and they repurchased over $2 billion of shares, with plans to repurchase $1.3 billion more by year end, even at these high stock prices. Now, I do always get a little bit nervous when companies repurchase stocks at 52-week highs, like we have seen with Dollar General, but I think with S&P Global, they have so much free cash flow that it won't be that big of a deal for them, even if they purchase it at a bit of a high. So S&P Global is a company composed of several different very large segments that are all very profitable, and we can see right here the breakdown by segment, how much the revenue grew for year over year. So for market intelligence, they had the smallest growth in about 6% revenue growth, but for their ratings business, it's picking back up finally at 36% revenue growth, which is very strong. Now, the commodity insights and mobility business segment are only up 9%, but their S&P Dow Indices division is up 18%, which I really like to see because it is my favorite portion of their business. Now, the S&P Dow Jones Indices includes indices like the S&P 500 and of course the Dow Jones. By just looking at their operating margin, you can see why I like this business segment so much. It is their most profitable business segment at 70% operating margin, followed by the ratings business at 61.9%. So both of these increasing is a very good sign. Now, if you guys want to see a visual of this, we can see that the 16% growth year over year is broken down into these last couple segments that we just took a look at. Now, one thing that I do want to show you guys is that they updated their 2024 guidance, and it's very strong because they revised all of them upward. Now, not only that, but they did revise it by a pretty large amount. The revenue growth was estimated to grow by about 8 to 10%, but now it's been revised to 11.5 to 12.5%, which is fantastic. Now, based on this, we can see that they did not expect such revenue growth in their ratings business. It was expected to be from 14 to 16%, but now they revised it up from 26 to 28%, which is much stronger than anticipated. Now, on the other hand, they did revise their mobility downwards as well as their market intelligence sectors, but their Dow indices business also got revised upwards. In general, S&P Global is a very dominant and strong company. I would love to add more into it at the right price. So now let's just take a look at some of the companies I want to sell. So the first one here is Ford, and I'll make this much more brief than the ones I want to buy because I think this is far less interesting to you guys. Now, believe it or not, Ford is one of my oldest positions in the portfolio, and it might actually be my oldest single position that's not an ETF in the portfolio. I bought only 7 shares at $11.29 per share, which was only $79.05 invested, so a very small position. Now, currently the stock price actually sits below my buy price at $11.13, so clearly this did not go so well, but with dividends reinvested, I actually am up 15.44% because I've earned $14.46 worth of dividend income. Now, the main reason I want to get rid of this position is because it's so small and insignificant. It's 0.2% of my portfolio, and I definitely don't see a reason to keep holding it going forward. Not only that, but when I first bought this position, I was betting on their EV trucks to do very well, and unfortunately that has just not panned out the same way I've expected. Because of that, I don't think the company has the same upside that I was originally hoping for, and I think I'm going to be selling this position soon. Now, just for fun, let's take a look at their performance. We can see right here they were climbing pretty high at $14.55 per share, and here's when I should have sold my entire position. Now, I instead decided to hold on, and I got punished pretty hard for it. It dropped over 30% after very bad earnings. Since then, it has been fighting to climb back up, but unfortunately the company's just not performing that well overall. Looking at the 5-year time frame, we can really see how hard of a time this company has had. In COVID, they did crash down really low, and then 2022 they skyrocketed up, but since then they have crashed back down, have just not done much for the past couple years. Now with Ford, of course I was hoping to sell it at a bit of a profit, but at this point I just don't care too much. It's a very small position. I just need to sell it sooner rather than later. Now next we have 3M, which has performed a little bit better than Ford for me, up 17.92%. But we can see here the current price at $133.53, and I paid about $124.68 for my only one share that I did purchase. Now at the time, I don't really know what I was thinking. I think I was thinking of building a bigger position, but I ended up purchasing one share and just sticking to it, and at some point it just didn't make sense adding any more into the company. Because of that, I was stuck with a very small allocation, just like with Ford, at about 0.3%. That's the main reason I want to sell this position as well. As I have explained in previous videos, I try to make my positions at least 1 to 2%. If they're very speculative, maybe 1%, but if they're not so speculative, at least 2% of my portfolio, and these are just too small to make the cut. Now, in terms of dividend earned, at first I was earning a pretty good dividend on the company. I think it paid over a 6% dividend yield, but then of course they slashed their dividend. Because of that, my dividend payout went much lower than that. Now, looking at 3M stock price, they have had a fantastic year to date, up 45%, and I actually did purchase this stock as a turnaround play. Now, to see where I purchased it, we can look over here. I purchased it at $124 per share, which is probably somewhere around maybe this time frame right here, after it had already crashed a lot from its highs. Now, unfortunately, it was not done crashing then, and it kept crashing down all the way to about $70 per share, where I did not pick up any more shares, and maybe I really should have in order to bring my cost basis down. The thing is, at this point, I already didn't want to hold the company. I was considering selling it at a loss just to get rid of it, so then I didn't make a decision in time, and because of that, I missed out on some big gains here for people who bought it at the bottom. Now, when it was crashing, so was Texas Instruments, and I was loading up very heavy on Texas Instruments. I just thought they were a better opportunity than 3M at the time. Now, in terms of performance, of course, 3M has actually outperformed from October of 2023 till now compared to Texas Instruments, but both have done very well, so I'm still happy with my investment in Texas Instruments. And I'm sure that at least some of you guys who have been watching the channel could have guessed the last stock that I want to sell, and that's Intel Corporation, INTC. Now, this is actually my only negative stock in my portfolio at the moment. I purchased 24 shares at an average cost basis of $24.82. Now, the current price sits below that at $24.05, and originally I didn't really mind because they were paying out a dividend, but since then they've decided to cut their dividend at least for the foreseeable future. Because of that, while the stock price is red, Intel will not be producing any sort of returns for me. Now, in total, I only invested about $595 into this position, and I was hoping to make it about a 1% portfolio position of mine. Now, because it's such a small position, I do have faith in the turnaround. I'm going to continue holding this company at least for now, and if there are any updates to that, I will let you guys know. Now, the reason that I originally purchased this position is for the turnaround, and if they're able to execute, I'll be holding them past 2025, but if not, I'll probably be selling it at some point in 2025. Currently, I'm down about 2.17%, and my allocation is at 1.2%. Looking at the performance, this is absolutely wild. This company is one of the worst performing companies within the S&P 500 and is down 50% year to date. To be more exact, right now it's ranked 500 out of 503 companies for the worst performing company in the S&P 500. Now, a couple months ago, I did make a video on why I was buying more Intel shares. And if you guys want to check that out, check out this video right here. A lot of my points still stand for the company. Now, in the past 5 years, the company's stock price is down even further. And I had bought it around here, I think the first time, about $27 per share, hoping for the turnaround. And that actually did happen when their stock price peaked at about $45, I think, per share. Now at this point, it was actually my best performing position within the portfolio and I could have taken some pretty good gains from there. Now a big reason why I did not take gains is because I only owned 3 shares at the time and it was just such a small position that the amount of money I would have made from selling the shares just didn't make any sense. Because of that, I kept holding the company and got punished pretty hard, as you guys can see right here. Now I am hoping that they'll be able to turn it around in the next year or two, but if they're not able to, I'm fine unloading the company and losing some money on it. As always, that does bring us to the end of today's video. I really hope you guys enjoyed watching me go over the 3 stocks I'm looking to buy in 2025 and the 3 stocks I'm looking to sell in 2025. Now, if you guys want to see me go over some companies that are on my watch list that I don't already have in my portfolio, let me know down below so I can make a video on that as well. Also, if you did make it this far into the video, let me know down below which stocks you're planning on buying in 2025 and which ones you're planning on selling from your portfolio. If you haven't yet watched last week's video where I do talk about my dividend income for the month of November, check out this video right here. And if you want to see a video of me going over my recent buys into Google, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching and I will see you in the next one.